Hello everyone. So today we will be discussing a past paper question of the topic depreciation for AS level accounting. So the year is 9706, variant 22, February, March 20. Okay, and the topic is depreciation. So I will straight away start the question. So the question says depreciation is provided for by a business when accounting for non-current assets. So straight three possible causes of depreciation. Okay. So the causes of depreciation are very simple. Economic factors and usage, time, technological change. Okay. So these are the reasons for the causes of depreciation. Okay. So part one is done. Then moving forward, part two. Explain two accounting concepts. We have to explain two accounting concepts which are applied when providing for depreciation. So this is for 2 marks. So it means 1 mark for each concept. So we have to also explain the accounting concept. So depreciation is in accordance to prudence concept. Prudent concept says that to avoid overstating of profits and non-current assets. The other concept is matching concept, or we also say accruals concept. It says that the cost of asset is matched with the income generated over the life of asset. So prudence concept says that we cannot overstate our profit and the value of non-current asset. And matching concept says that the cost of asset is matched with the income generated over the life of asset. Like we are earning some profit from the non-current asset, so we also have to match the expenses the assets is generating. Okay. So moving forward, the directors of K Limited prepare financial statements 31st December. So in depreciation question, we have to see the year end also. Okay. We have to remember the year end because sometimes the depreciation is policy is on month by month basis. So we have to calculate the depreciation according to the number of months. So we have the balances at 1st January 2019. Motor vehicles cost 180,000, motor vehicle depreciation 105,000. So these are the brought down balance. During the year ended 31st December 2019, a new motor vehicle was acquired for 50,000. A motor vehicle which had cost 40,000 and had been depreciated by 17,500 was sold for 16,500. So a new motor vehicle was acquired and an old motor vehicle was disposed of. In the question of depreciation, we have to clearly see and understand the policy of the company. The company policy is to depreciate motor vehicles at 25% annum using the reducing balance method. A full year's depreciation is charged in the year of acquisition. Acquisition means in the year of purchase and none in the year of disposal. So whenever the machinery or the motor vehicle or an asset is purchased for this company, the policy is that a full year depreciation will be charged in the year of purchase, whether it is purchased at the start of the year or at the end of the year. And no depreciation will be charged in the year of disposal, which means if it is sold at the end of the year or at the start of the year, if it is sold, that year no depreciation will be charged. So for the depreciation question, number one thing is very important, that we sometimes the year end is not 31st December, it is May or June or April. So first we have to see the year end and keep in mind. And next thing is the policy of the depreciation. Policy of the depreciation is really important, because sometimes the company's policy is on month by month basis, in which we have to prorate the depreciation expense. So two things we have to keep in mind: the year end and the policy of the company's policy, how he is depreciating the asset. Now we will come towards the requirement. Okay, so part B, prepare for the year ended 31st December 2019 motor vehicles provision for depreciation account. So we have to make a provision for depreciation account for motor vehicles. So it is a provision account. So the brought down balance will come on the credit side, which is 105,000. The other two things which come in the provision for depreciation account is income statement, which is the charge for the year, and the depreciation of the asset which has been disposed of. We do not keep the depreciation of the asset which has been disposed of in our books. Also, the cost of asset is not will be not kept in our books, but in this question we have to make the provision for depreciation account only. So we will take out the depreciation of the asset which has been disposed of from our books. So when depreciation is charged, provision for depreciation account is credited and income statement is debited. So when we take out the depreciation of our from our books, so provision for depreciation account is debited and disposal account is credited. Okay, so now first we will see what is the depreciation for the disposal. So a motor vehicle which had been cost 40,000 depreciated by 17,500. So accumulated depreciation has been given in the question. We do not have to calculate it. So we will simply enter 17,500. Okay. Now we have to calculate the depreciation for income statement. So the method is reducing balance method. So the formula for reducing balance method is cost minus accumulated depreciation into percentage. But when we calculate depreciation for income statement, so I always tell my students to make three parts for the calculation of income statement: new asset, brought down asset, which means the remaining asset, and third is disposal. By this method, we will not miss any depreciation charge for the year. So new asset we acquired for 50,000. Okay. So 50,000 multiplied by 0.25. So we will get the charge for the year for the new asset. So we do not have to see the date of the purchase, because the policy is a full year's depreciation charge is a full year depreciation is charged in the year of purchase. Okay. So the new asset depreciation is 12,500. Okay. Then moving forward, now we have to calculate the depreciation for brought down asset. It is the charge for the year. Remember, I am telling the working for charge for the year. Okay. So since the balance, the method is reducing balance method. So first of all, the cost of asset which was disposed of will be removed from the cost of asset. Okay. So it will be, the cost will be now 140,000 will be cost. Provision for depreciation. So the provision for depreciation was 105,000. and the asset which was disposed of, the accumulated depreciation was 17,500. So we will not keep in our books. Remember that students do not take out the depreciation of the disposed of assets. If we do not take out the depreciation of the disposed assets from the brought down balances, our answer will be wrong. Okay, and the concept is also wrong. Okay, so 105,000 minus 17,500, it is 87,500. Okay. Okay, then we will multiply it by 0.25, the rate of depreciation. So our depreciation will be 13,125. Okay, I have done the working separately. Now, this disposal of asset, we have to calculate the charge for the year if the company's policy is month by month. But in question, there is no month by month. The policy is none in the year of disposal. So there will be no depreciation charge in the year of disposal. Okay. So we will simply calculate total this. So it will be 25,625. Okay. And we will enter it 25,625. Now we can balance off our accounts. So the carried down balance will be 11,13,125 and brought down will be the same. Now the next part is we have to make the disposal account. So for disposal account, there are three entries. The cost of asset, okay, which is 40,000. The provision for depreciation or the accumulated depreciation of the asset is 17,500. And the asset was sold for how much? It was sold for 16,500. These three entries are entered in the disposal account. Then we can calculate the gain or loss on the disposal. In this scenario, there is a loss on disposal. So we will quickly calculate the loss. 17,500 plus 16,500 minus 40,000. So there is a loss of 6,000. Okay. I hope you all understood the question. The policy and the year end is really important. We should keep in mind. Okay. So I will meet you in the next video with another question. Thank you so much. Take care.